Welcome everyone to the first HY-IIS Dialogue of 2021. My name is Pascal Lamb and I am a member of the Access to Insurance Initiative, the HY Secretariat. I will be your moderator for today's webinar. For those of you joining us for the first time, these dialogues are a joint initiative between the HY and the IIS, the International Association of Insurance Supervisors. They deal with current and relevant topics that supervisors are faced with and provide a platform for knowledge and peer exchange. And today's topic is no exception. If anything, the new accounting standard, IFRS 17, is perhaps one of the most significant developments for the insurance sector in recent years. Before introducing our speakers for today, I am very happy that we have Connor Donaldson from the IIS, our partner in organising these webinars. And I'll pass over to him to say a few words. Welcome, Connor, and please go ahead.
Oh, thank you very much, Pascal. And good morning, good afternoon to colleagues joining us today. Let me start by wishing colleagues a Happy New Year. I hope that 2021 will bring greater stability to each of you and good health and prosperity. Let me also say a happy early Lunar New Year to colleagues joining from Asia. I'm very pleased to be here today to offer some introductory remarks on behalf of the IIS on this discussion of accounting standards in IFRS 17. Good quality financial reporting is a must for good prudential supervision. There is a spectrum of regulatory approaches in the insurance sector. The IIS has stated publicly that it is most desirable for general purpose financial reporting to be as consistent as possible with prudential reporting. Alignment of general purpose accounting standards with regulatory reporting will reduce costs, minimize the need for complex reconciliations, better align risk-based supervisory assessments with the financial management of insurers.
If you are the meeting host, enter the host key followed by pound. If you are not the host, enter the numeric meeting password followed by pound.
Sorry, there was just a request for me to enter a meeting host PIN. Insurance supervisors and regulators need to decide on their approach to IFRS 17. Depending on these decisions, supervisors must also adapt the financial analysis tools and techniques used to continue to gather meaningful information, which can also be shared with the market. This may pose a challenge from the technological perspective, as financial analysis relies more on automated processes. Even if the decision is to maintain separate prudential reporting, the supervisor must adapt its processes and resources to reconcile prudential accounting information to ensure effective public disclosure. In any case, the operational impact for supervisors, as for insurers, is major across data, systems, and processes. Application of IFRS 17 also requires significant actuarial input, which may pose a challenge for jurisdictions with limited actuarial services in their market. Let me close by saying I'm very pleased that the HYI is facilitating this discussion today and has brought together excellent people to share their perspectives on this important topic. Thank you again on behalf of the IIS, and back over to you, Pascal.
Thank you, Connor, and apologies for that interruption. A lot of you will be familiar with our first round of speakers today, as they are both former members of the IIS Secretariat. Therefore, I am pleased to welcome Peter Windsor, Senior Financial Sector Expert at the International Monetary Fund, and Jeffrey Young, Senior Advisor at the Financial Stability Institute. Peter and Jeffrey will be presenting their joint paper on accounting standards and insurer solvency assessment. Following their presentation, we'll also be joined by supervisors from the Central Bank of Malaysia, Bank Negara, and the Central Bank of Jordan. Before we begin, just some quick final logistics. This dialogue is a closed-off session for supervisors only, and it is being recorded. To improve the audio quality, participants are muted during the presentation. But please feel free to ask questions in the chat box on the right-hand side. You are also welcome to unmute yourself by clicking on the microphone icon next to your name. If you encounter any technical problems, please send the HY Secretariat a chat message or an email at dialogues@hy.org. Finally, an audio translation is also available for our French-speaking participants. You can access this by downloading the Interatio application on your smartphone or tablet, or you can listen via your web browser. My colleague has just uploaded the PowerPoint presentation and also included the links and the instructions in the chat box as well. I know we are now all keen to start, and we've got a packed agenda today, so I will now hand over to our experts. Peter, Jeffrey, once again, welcome, and please go ahead.
Thank you very much, Pascal. Hello, everyone. It's a great pleasure to be here with everyone in a virtual environment. It would have been better if we could meet face-to-face, but I suppose everyone is used to this. I'm Jeff Young, for those who I've not met before. I work for the Financial Stability Institute at the BIS, and maybe I'll ask Peter to also give his welcome, and we can press on.
Hello, everyone. I'm Peter Windsor. I work for the International Monetary Fund. I'm in the Monetary and Capital Markets Department, and some of you all know me from my time at the IIS from 2009 to 2018.
Great. Thanks, Peter. If you move to the next slide, this is what we plan to cover. I'll take the first two bullets, explaining why we did this paper, and then I'll cover the first part of the paper on the existing regulatory approaches. Moving on to the next slide. So this is really a first joint FSI and IMF paper that we did together. So it was really groundbreaking in a lot of ways, and I was really happy to be able to work closely with Peter on this project. So just as a background, the paper is published in two formats. On the FSI side, it's published as an FSI Insights paper. This is our publication series that we launched back in August 2017. The papers under this series cover various regulatory and supervisory topics, typically focusing on comparing how different countries or different authorities are doing things. And the aim of our FSI Insight publication is to contribute to the policy discussion, to help authorities around the world to learn from each other, and hopefully to share learnings and to address common challenges faced by the different countries. From the IMF side, maybe Peter, you can correct me if I'm wrong. The IMF has published this as a working paper. This is another series of publications by the IMF that focuses on research by specific authors or IMF staff members, and they are published with the same similar objectives as FSI Insight, to elicit comments and to encourage debate. So why did we choose this topic? Well, there are really three reasons. So first of all, we are very much demand-based. That's how we like to characterize ourselves. So we know that IFRS 17 is a huge topic. It has been very long in the making, and when we talk to our stakeholders, meaning the insurance supervisors from all over the world, we came to know that this is a pressing issue, and people wanted to understand what's going on. So the paper aims to highlight the technicalities of IFRS 17 from a supervisory lens. It also raises some issues on what the potential impact might be on insurance companies around the world, and provide some considerations on whether IFRS 17 is or is not suitable for solvency purposes and some of the considerations. So we'll cover some of these points as we go along. Over to the next slide. So now let's move on to the first part of the meat of the paper. But before we do that, we go to the next slide, which is a poll question to introduce the topic. I'll hand over to you, Pascal, to launch the poll. Okay, so I see that the poll is open. So it's a question to just get a feel of our audience today. So in your jurisdiction, which of the following best describe regulatory requirements on how insurers should prepare regulatory reports for solvency purposes? So are insurers required to use accounting standards for regulatory reporting, for solvency reporting, or are they not required to use accounting standards, or they have the option to but do not or are not required to use accounting standards, or none of the above? I will leave this in Pascal's good hands to let us know when the poll is closed.
We're still waiting for a few more people to vote. But it should be closing in over a minute, just over a minute now.
Okay, I see that the poll results are in. Let me see. So, okay, so most of the audience today comes from jurisdiction that require insurers to use accounting standards for regulatory solvency purposes. This, to me, is a rather interesting result. It is somewhat contrary to the sample that we have for this paper. So moving to the next slide. So for the paper, we surveyed around 20 insurance authorities from different geographical locations, different economies, just to get a feel of where the different jurisdictions are with respect to the use of IFRS 17 or IFRS in general for prudential and public financial reporting purposes. And on this slide here, you can see it's a very high-level summary. We attempt to capture the range of regulatory approaches currently, so pre-IFRS 17 implementation, whether jurisdictions require IFRS to be used for prudential purposes and or public financial reporting purposes. So the red circles you can see on this slide depicts a public financial use case, and the blue circles show the prudential purpose use of IFRS. And across the horizontal, as you go along from left to right, it shows the application to different types of insurance entities. So starting with insurance legal entities on the left-hand side, all the way to the right-hand side, foreign-owned insurance branches. So the point here is that for insurance legal entities or solo insurers, you can see the first on the left-hand side, the column on the left-hand side here. Not many jurisdictions actually require solo insurers to use IFRS for regulatory solvency reporting, and this you can see the empty part of the blue circle right at the top left corner of this slide here, contrary to what we are seeing in the poll that we've just launched just now. A small number of jurisdictions require IFRS to be used for both public financial reporting and regulatory solvency reporting for solo insurers, and that's the intersection we see at the top left corner there. An even smaller number of jurisdictions allow but do not require the use of IFRS 17 for both purposes. If you move on to the second column, for insurance groups, so requirements for insurance groups follow a rather similar pattern, although there's slightly more jurisdictions that require insurance groups to use IFRS for public financial reporting. And if you move to the next column, foreign-owned insurance subsidiaries. Very similar to insurance legal entities, the pattern, probably because I suppose in most jurisdictions there's no different, the requirements imposed on foreign-owned subsidiaries are pretty similar to locally owned insurance legal entities. And finally, for branches, foreign-owned insurance branches, the rightmost column is rather dispersed. So we have a wide range of approaches that we found out through the survey that we did. Now, why is this the case? If we move to the next slide. So the natural question one can ask is, what is the rationale for the different regulatory approaches? Now, of course, most are due to legacy or historical carryover of approaches reflecting the different pace of development of regulatory frameworks as well as regulatory philosophy. So the table here aims to tease out a little bit some of the response that we received on why there are different application of IFRS or adoption of IFRS for accounting and prudential purposes. When we pose this question to the survey authorities, the main reason given is because public financial reporting and regulatory solvency reporting, in the view of these authorities, have very different aims. So the primary aim of accounting standards is to provide transparent and comparable financial information of firms, including insurance companies, to enable investors and other market participants to make informed decisions. On the other hand, the regulatory or prudential standards are aimed at assessing the ability of insurers to meet their insurance obligations. Now, accordingly, it follows that it's understandable that accounting and regulatory standards may have somewhat different emphasis and priorities, and which can result in different technical requirements. Moving on to the next slide. So here we attempt to summarize a little bit the views of the authorities, and also an event that we held back in 2018, I believe it was. And this chart shows here the different objectives that may explain some of the different philosophies and approaches that we see here. So interestingly, in the middle, there's an intersection. So there is some commonality in terms of what accounting standards aim to achieve and what regulatory standards aspire to achieve. So both sets of standards aim to enable comparison of financial results of firms, and this includes, of course, insurers, and to provide useful information to users, which should include insurance supervisors. Now, given these common aims, significantly different accounting and prudential requirements may be difficult to reconcile, because if you're trying to achieve something, the same objective, why would you apply different approaches? Now, this is something that we raised in the paper. Now, comparability is very important to help ensure that all insurers are treated consistently from a supervisory perspective, especially if supervisory actions are to be taken on the basis of balance sheet triggers. Some supervisors take the view that accounting standards are more focused on performance measures, which seem to imply that they are not relevant for insurers, but this is not necessarily the case. Now, supervisors should also be interested in performance measures that are embedded in accounting standards to assess suitability of insurance business model, for example. Investors and other users of general purpose reporting also are very interested in the financial position of an insurance company. The other differences you can see is that accounting standards places equal weight on income statement and balance sheet, whereas from a regulatory supervisory perspective, usually we are more focused on the balance sheet. Now, moving on to the next slide. I know that I'm a bit behind time, so I'm going to speed up a little bit. So in the end, what happens if you have this dual track of requirements? You can end up with two different sets of accounts. One is a so-called accounting balance sheet, and the other is a regulatory balance sheet, as shown on this chart here. Now, the main difference being the insurance liability component, and because insurance liabilities are typically the largest item on the balance sheet, this can really impact on the financial signals coming out from either set of financial statements. Moving on to the next slide. Another touch point between accounting standards and solvency requirements relate to insolvency triggers. And this chart here it shows a stylized example of what can happen. And we assume that there is a market shock And the upper part, the first half of the slide here is a regulatory view based on regulatory balance sheet. The bottom half is an accounting view based on accounting balance sheet. Now, due to mainly the discounting requirements that differ in the regulatory balance sheet, we have assumed here that the discounting includes the risk premium from assets, meaning the discount rate under the regulatory basis is higher than the accounting basis. Therefore, the liabilities after the fall in asset value falls more under a regulatory approach compared to the accounting approach. And as a result, you can see that this particular insurer is still solvent. Let's assume that the minimum capital requirement is 100% solvency ratio. But on an accounting basis, on the bottom right corner of this screen, you can see that this insurer is actually insolvent by 10 currency units. And just to show that this can really pose a problem, because the supervisor may not have a legal basis to impose the strongest supervisory measures prior to a corporate insolvency triggered by a creditor in an insolvency regime that relies on accounting balance sheet. So this is just one example on a problem that can occur when you have two different sets of accounting bases. Moving on to my last slide before I hand over to Peter. There are some other interactions between accounting and regulatory standards, and here there are three that we list, and maybe I'll just focus on two. The first one is that accounting standards also drive the strategic direction of insurers. So depending on how the view of the insurance company, which set of financials they rely on to drive their business, will have implications, potential implications, because this may translate to the different different products that they offer, different business strategy, different risk appetite. So this is another touch point that we should be aware of. And finally, the going concern versus the gone concern view. So this may so some supervisors consider that regulatory balance sheet should be a gone concern compared to a going concern view, and as a result, this may have different technical requirements. For example, some margins in insurance liabilities may be recognized as capital resources by a supervisor, but not on the accounting balance sheet. So I know that I breezed through very quickly, but I just want to make sure that Peter has enough time. So over to you for the next section, Peter.
Thanks, Jeff. So I'm going to be talking about the use of IFRS 17 for prudential purposes. Next slide, please. We're going to start, like Jeff did, with a poll question. That question is, do you think IFRS 17 is fit for purpose to be used for regulatory solvency assessment of insurers? Yes or no? And we know that we have a bit of a different sample here compared to the sample of supervisors that replied to our survey for the paper. So in the paper, we found that the survey jurisdictions were divided on whether it is important for insurers to implement IFRS 17 so that financial positions are comparable across jurisdictions. A concern among the survey jurisdictions is the principles-based nature of the standard that allows a wide range of accounting practices, which may lead to some differences in valuation results. So I'll just wait for these poll results to come in before we move on. I think we've got a couple of minutes left. So I'll be very interested to see what the results are here. From the first question that Jeff asked, it's clear that we have a bit of a different sample. I think our sample did include quite a few European jurisdictions which have Solvency II already in place. And they have their own valuation basis. Actually, in the interest of time, I might move on to the next slide while the poll results are still coming in. Don't mind. Okay, we have the poll results, and we have a majority thinking that IFRS 17 is fit for purpose. Significant no answer, and that's fair enough. So that's interesting. So what we found was that few survey jurisdictions plan to adopt IFRS 17 for regulatory solvency purposes. And some of the reasons for using IFRS 17 are to avoid multiple financial signals, like Jeff just explained. Also to benefit from the auditing controls that come with financial reporting, and to reduce costs for insurers. Some plan to use IFRS 17 as a starting point and modify for regulatory solvency purposes. The two main guiding principles when reviewing capital adequacy frameworks for IFRS 17 is to provide the right incentives to insurers to manage their risks properly, to achieve prudential outcomes in terms of policyholder protection. And that, again, goes back to those the slide that Jeff showed in terms of what are the different reasons for having financial reporting and prudential reporting. Some potential changes due to regulatory solvency requirements are capital requirements. There might need to be revised risk factors that are applied to technical provisions, because now technical provisions are based on different criteria. So in IFRS 17, of course, you've got the discounted future cash flows, plus you've got the risk margin, plus the CSM. So and also capital resources, there may need to be an adjustment for the calculation of retained earnings, as an example. So moving on to the next slide. Reasons for not planning to use IFRS 17 for regulatory solvency purposes. And probably the most significant is comparability. A number of supervisors don't believe that there's a significant enough comparability because IFRS 17 is principles-based. Supervisors that responded this way prefer to have a more prescriptive set of regulatory requirements. Stability is another reason. Supervisors in some instances are very happy with the approach that they have for regulatory reporting, and they prefer not to require updated valuation assumptions. We have those differing objectives that Jeff covered before, with IFRS seen as focusing on earnings measurement, and the prudential objective of safeguarding policyholder interests under a wide range of potential scenarios is what supervisors are focusing on. Cost. Now, this is also about the cost to supervisors as well as the cost to insurance companies. Some supervisors see a significant implementation cost, outweighing the perceived marginal benefits of moving to IFRS 17-based prudential reporting. And materiality. So, in some instances, not many local insurers are subject to IFRS. So, in a number of jurisdictions, IFRS may apply to the larger insurers, but not to many smaller local insurers. So, moving to the next slide. So, let's talk about the potential impact of IFRS 17 on supervisors and the industry. Next slide. So the big headline that we have here is that the surveyed supervisors generally agree that IFRS 17 is positive for financial stability. So that's excellent. They see that there will be easier performance assessment, more transparency of profitability trends. So this is not just about the measurement approach that IFRS 17 has. but it's also about the disclosure requirements that come with IFRS 17. Another thing that is a benefit is that there will be updated assumptions, so updated measurement of insurance liabilities. It also, in some cases, moving from the local GAAP to IFRS 17 will end upfront profit taking, particularly on long-term life insurance products. And there will be more comparability of financial information. This will be both within a jurisdiction and across jurisdictions. Moving to the next slide. In terms of supervisory implications, there was actually a wide range of views on what the impact on policyholders might be. Some supervisors thought there would be no impact. Other supervisors thought there might be a significant impact as certain business models are revealed not to be economic for the insurance companies anymore, so that might lead to withdrawal of certain products, or it might lead to higher premiums being charged for certain products. In terms of supervisory reporting, the supervisors will actually have to look at new performance indicators based on IFRS 17 and new profitability measures as the profitability emergence will change under IFRS 17. So supervisors will need to develop new benchmarks. There is the last point we talk about the premium allocation approach. I think this is very important for supervisors in emerging and developing economies, because a number of such economies don't have large life insurance industries with long-term products and have a significant amount of what one might call general insurance or non-life insurance or property and casualty insurance, to give them the different kinds of terms that are used. So these are typically 1 year sort of products and would fit into the premium allocation approach, which is a simplified approach, which would mean that implementation of IFRS 17 would be a little less complex in those jurisdictions that primarily have that kind of insurance with short term. So that brings us to the next polling question. In IFRS jurisdictions where regulatory solvency assessment is not based on accounting standards, insurance supervisors need not care about IFRS 17. Do you agree? Give me a chance for a drink. This is a very important aspect to consider for those that aren't intending to use IFRS 17 at least immediately for their regulatory reporting. So essentially what we're asking here is, could there be other impacts? I'm very interested in the response here. Okay, so we have a majority of those who have answered have said no, that insurance supervisors need not care about IFRS 17. Well, Let's move on to the next slide and see if we can have a discussion about that. So even if IFRS 17 isn't used for regulatory purposes, there still can be an impact that supervisors have to think about. Now, one of the issues is that IFRS 17 is a significant implementation challenge for insurers. Some people call it more of an IT project than an accounting project. So that means that there is operational risk that you need to consider. The insurer's systems need to be updated for the data requirements for IFRS 17, and any time there's a significant IT project, that comes with operational risk. Of course, we've already talked about conflicting financial signals. So insurers have to manage to those different signals, which could lead to misaligned incentives compared to what the supervisor would like insurers to be focusing on. Capital flight is another issue. High cost. A number of insurers around the world have outlined their concerns about the cost of implementing IFRS 17. It is often a more complex approach to insurance accounting than what is currently in place in existing accounting. Also, just the cost of change. Anytime that there is a significant change, that comes with a cost. Insurers are under significant profitability challenges around the world with low interest rates, etc. So the cost is a significant issue. Also, there could be an issue with differential approaches to IFRS 17 implementation, being principles-based. There are a range of approaches that can be taken to discount rates, risk margins, etc. And that could lead to certain insurers becoming outliers. When an insurer becomes an outlier in terms of how it actually accounts for its insurance liabilities, this could become a problem in a market. It could mean that the way of determining premiums to charge are different and could cause market implications, and also the way investors look at that insurer compared to other insurers could become a problem. Moving on. In terms of other potential impacts, the issue is that we don't actually know in many cases what the impact will be. So we haven't seen many insurance supervisors undertake an impact study. We haven't seen insurance industries as a group within countries undertake impact studies and publish the results. So even though we're only a couple of years away from the implementation of this significant change to insurance accounting, we don't actually know necessarily exactly how this will impact financially on a lot of insurers. Where there have been impact studies, they've shown a wide range of results. In some cases, they come up with similar contract values to the existing local GAAP. Sometimes you get lower values depending on the nature of the insurance contracts, and sometimes you get higher values. So that's pretty much all the possibilities. What we do know is that there's less impact on non-life insurers. That premium allocation approach is somewhat similar to existing approaches for calculating insurance liabilities. Insurers aren't expected to drastically change their business strategies, but in some cases they may have to if their products don't seem to be economically viable under IFRS 17. Insurers may need to review their asset liability management strategy, and of course we haven't mentioned IFRS 9 yet, but the implementation of IFRS 17 and IFRS 9 are twinned. So they'll need to consider how assets are valued and manage those assets and liabilities together in a new accounting environment. And that might, one of the big issues there is likely to be a longer profit emergence, which matches the delivery of insurance services over time. There's potentially better market conduct outcomes because of that incentive to provide service and match that with the profit emergence over time. We do believe that having an economic basis for accounting will contribute to enhancing insurers' enterprise risk management frameworks, which will come from the need to have a stronger actuarial function and data governance controls. Next slide, please. So, implementation challenges. I need to speed up a little bit. So, I've already talked about the IT and data challenge, the cost challenge. There's also the technical interpretation. Given it's a principles-based standard, that means that there needs to be a lot of professional judgment, and that means that you need to have technical interpretation, which might vary. And this directly leads to the main point that we'd like to get across, is that there is a need for expertise, both at insurance companies and at supervisors, to understand the reporting that they might be getting under IFRS 17. Even if they're not getting solvency reporting, they still need to understand IFRS 17 to understand the profits or the losses that are being generated to undertake performance assessment. So expertise is a big issue, and one of the most significant, of course, is actuarial skills. IFRS 17 requires significant actuarial skills to implement. So this is an issue particularly in emerging and developing markets. In fact, it's an issue for advanced markets as well, but it's even a deeper issue for emerging and developing markets. So I'll move on to my concluding remarks. So we do believe that IFRS 17 is a positive development. It will bring positive benefits to the insurance industry in the long term, as well as improve financial stability, despite the significant implementation challenges. The big issue is that we need everyone across the world to do more work to fully understand the impact of IFRS 17, regardless of the regulatory approach. We urge regulators and insurers around the world to undertake impact studies, and that should start now. So there are valid reasons for the range of existing regulatory approaches. Jurisdictions not intending to implement IFRS 17 should reconsider their approach with some experience under IFRS 17. There may need to be greater specification of IFRS 17 techniques and inputs, but there needs to be global coordination of how that is actually done, lest there be local versions of IFRS 17 developed. And generally there needs to be a lot more engagement between the insurance industry and supervisors. So we advocate quantitative impact studies. And I'll stop here.
Thank you, Peter. And for our participants, if you haven't already seen, there is a link to Peter's paper in the chat box. Also, I am conscious of a few messages coming through the chat, and I think this is testament to how pressing this issue is. For those of you who have colleagues wanting to join the webinar, we are now at full capacity, but we will be sharing the recording and the presentations after this webinar, so please bear with us. In the meantime, thanks again to Peter and Jeffrey. While we had some mixed polling results there, and that presentation was certainly a rallying call for those supervisors who are still not engaging with the accounting standards.